we are diving straight into the action with massive moves in the financial world. Elliptic has just secured a massive $120 million Series D fundraise, led by One Peak with participation from Nasdaq Ventures, Deutsche Bank, and the British Business Bank. This investment signals a massive shift, positioning Elliptic as the definitive standard for on-chain analytics, proving that institutions are betting big on this technology to navigate the future of digital assets. This funding fuels their mission to deliver enterprise-grade compliance infrastructure for the world's largest financial players. And finally, we look at market volatility and unexpected health scares. Despite concerns about a potential stock market crash, the emergence of hantavirus cases on a cruise ship is bringing renewed focus to public health and specific sectors like the FTSE 100. We examine the mixed signals from Moderna and Croda International as investors weigh the impact of this new health concern against ongoing vaccine development and market recovery. Elliptic, a global leader in digital asset decisioning, has successfully closed a $120 million Series D funding round, valuing the company at $670 million. The round was led by One Peak, with participation from major financial institutions including Nasdaq Ventures, Deutsche Bank, and the British Business Bank. This significant investment underscores the growing institutional confidence in Elliptic as the standard on-chain analytics provider for digital assets. The funding is aimed at accelerating Elliptic's mission to deliver enterprise-grade on-chain analytics to the world's largest banks, fintechs, government agencies, and crypto and payments companies. These investors, collectively managing trillions in daily market activity, view Elliptic as essential infrastructure for navigating the digital asset landscape. Gary Offner, Senior Vice President and Head of Nasdaq Ventures, emphasized the need for trusted infrastructure, stating, "As digital assets become more embedded in the global financial system, institutions need trusted infrastructure to manage compliance and risk at scale. Elliptic's platform plays an important role in providing that infrastructure, helping firms navigate digital asset adoption with confidence and integrity." Sabi Bayzad, Global Head of Digital Assets and Currencies Transformation at Deutsche Bank, highlighted the importance of these frameworks, noting, "The sustainable growth of digital assets depends on strong, institutional-grade risk and compliance foundations. Our investment in Elliptic reflects our focus on strengthening these foundations." Elliptic distinguishes itself through its pioneering use of AI-native compliance, which it introduced to enterprise scale in 2025. The company leverages a decade of proprietary data spanning over 65 blockchains to process more contextual information per transaction than competitors. This allows for automated triage, faster decision-making, and significantly reduced compliance costs, enabling compliance teams to resolve alerts in minutes rather than hours. Charlotte Lawrence, Managing Director of Direct Equity at the British Business Bank, noted the investment signaled support for UK technology scale-ups, while Humbert de Liedekerk-Beaufort, founding partner at One Peak, cited customer feedback as the key driver for investment, confirming Elliptic's position as the leader in digital asset compliance built on robust proprietary data. The market shift is profound. Stablecoins and tokenized assets are now core infrastructure, with stablecoins processing $33 trillion in transactions in 2025. Real-time compliance at scale is an operational necessity for exchanges and financial institutions handling this volume. Elliptic provides the intelligence infrastructure to enable this transition safely and at speed. Simone Maney, CEO of Elliptic, stated, "Financial systems are being rebuilt on-chain. The institutions leading that transition need an on-chain analytics partner that matches their scale, their sophistication, and their ambition." A former Connecticut financial consultant has been sentenced to 3 years in federal prison for defrauding a business client of over $2.5 million. Dominic N. D'Onofrio, 73, was sentenced Tuesday by U.S. District Judge Kari A. Dooley in Bridgeport to 36 months in prison, followed by 3 years of supervised release, after pleading guilty to 1 count of wire fraud on February 4th, according to the U.S. Attorney's Office for the District of Connecticut. D'Onofrio, who was the president and owner of Windstar Financial Services, Inc., admitted to the fraud stemming from a deal involving a home heating oil company. Court records indicate that in January 2013, Wisconsin-based Randall Robert Beinversi Holdings sought to acquire a renewable fuel business and hired D'Onofrio for consulting services. In early 2014, D'Onofrio allegedly steered Beinversi toward purchasing Tioga Fuel, a home heating oil company in Philadelphia, and its associated properties. D'Onofrio reportedly inflated the purchase price, telling Beinversi the price was $2,050,567 when he had fraudulently marked up the price by approximately $1,300,000. D'Onofrio ultimately completed the transaction. During his guilty plea, D'Onofrio confessed to defrauding Beinversi of more than $2.5 million. The total loss encompassed the difference between the actual and inflated purchase prices of the Tioga properties, over $987,000 in fraudulent consulting, negotiation, and legal fees paid by Beinversi in 2013 and 2014, approximately $87,000 stolen from Tioga Fuel's account, and about $136,000 obtained as interest payments on a fictitious $1.25 million loan that D'Onofrio claimed Windstar had fronted. D'Onofrio had been indicted by a federal grand jury in the Eastern District of Pennsylvania on July 30, 2019, and was a fugitive until his arrest in Mystic on July 24, 2024. Following a failure to appear for a pretrial conference in Philadelphia on July 22, 2025, he was rearrested on December 3, 2025, and has remained detained. The case was subsequently transferred to the District of Connecticut for prosecution. A relationship columnist for the Toronto Star has offered guidance to readers navigating complex marital issues, focusing on emotional intimacy, financial realities, and personal boundaries. One recent query highlighted a situation where a woman deeply loves her spouse as a person, but has lost all sexual interest, leading to questions about divorce amid threats of self-harm from her partner. The advice columnist addressed the gravity of the situation, emphasizing that a partner's sexual happiness is not the primary responsibility of the other spouse. However, the columnist stressed that the relationship is not necessarily untenable due to coercion or blackmail, such as threats of suicide. Key recommendations centered on practical and emotional strategies. The columnist advised the reader to evaluate the relationship based on its current viability, rather than solely on sexual compatibility. A crucial point raised was the financial and social isolation inherent in the relationship, particularly in high-cost areas like Canada. Suggestions included exploring housing alternatives, such as co-owned duplexes, to create physical space, and actively seeking out social connections through groups or hobbies to build a support network. In another scenario, a reader expressed concern about managing the logistical and emotional strain of being a spouse to an accountant during peak tax seasons. The advice provided was proactive. Anticipate busy periods, plan ahead in advance, and bolster social and practical preparations to mitigate the challenges of seasonal workload spikes. The recent surge in concern over hantavirus outbreaks is prompting investors to reassess market volatility, despite the memory of the COVID-19-induced crash. While early reports suggest the current situation is not on the scale of a full-blown pandemic, the emerging health alerts are being scrutinized for their potential impact on specific sectors and individual stocks. Reports of up to 11 hantavirus cases on a cruise ship in Argentina have brought familiar themes, flu-like symptoms, home isolation, and physical distancing, back into the news cycle. However, experts caution that this is not yet a full-blown pandemic scenario. In the broader market, the mRNA vaccine sector remains dynamic. Moderna's stock saw a significant jump of 13.95% in the past week, attributed to ongoing international vaccine development efforts, suggesting a potential boost for the firm. However, the analysis points to specific vulnerabilities within the pharmaceutical sector. Croda International, LSC, CRDA, serves as a key case study. The company's stock surged during the COVID-19 pandemic due to soaring demand for its lipids, which are essential for vaccines. Post-pandemic, sales have reportedly dropped as customers shifted focus to existing inventory, and the company's utilization of pandemic windfall, including high-priced acquisitions, has been questioned. The hantavirus outbreak presents a potential counter-narrative. The author suggests that stabilizing inventory levels combined with increased vaccine research could provide a short-term boost to Croda. Nevertheless, investors are advised to be cautious, as past experiences show that temporary demand surges can fade quickly. The long-term outlook remains focused on the durable trend of mRNA vaccine interest. If this trend solidifies, future windfalls could become more frequent, significantly altering the investment landscape and making Croda shares potentially attractive for diversification. Overall, while the immediate threat is not a market crash, the situation warrants careful consideration for investors tracking sectors vulnerable to global health events, positioning specific companies like Croda for potential recovery based on long-term vaccine innovation.